Good morning, everyone, and welcome to our webinar on retirement planning, setting you up for success. My name is Gary Shepherd, and I'm your facilitator today. Before I hand you over to two esteemed members of our financial planning and advice team, James and Shanaka, I just need to quickly run through a few housekeeping and legal notes. Firstly, there is a Q&A option on the bottom of your Zoom screen. If at any point during the presentation that you have a question, I'm sure you will do. Please do ask away. We've allowed plenty of time at the end for questions, and I know James and Shanaka are more than happy to help. I must say, however, that they are not allowed to give you any tailored financial advice today. But there will be information on screen at the end of the presentation about how you can book a free call with a member of our team if there's anything in particular you want to discuss with them. Our compliance team has also asked me to outline some important T's and C's and risk warnings, which you should be able to see on screen. The presentation that we're going to run through today is intended to be for information purposes only, and it does not constitute financial advice or a personal recommendation. As I said, there is an option to book a call with a member of the team, but today we're here to be an aid to your decision-making process. Okay, well, that's more than enough of me. So it's with great pleasure I hand you over to James Egan and Shanaka Cristofoli. So they're here to get you ready for retirement and success. Hi, gents.
Thank you very much, Gary. Good morning, ladies and gentlemen, and thank you ever so much for joining us on this webinar today. I'm delighted to have you with us as we explore the intricacies of retirement planning. I hope we can offer some valuable insights into creating a successful retirement plan. So, without further ado, how do you plan for retirement? Well, a good starting point is to think about what you want your retirement to look like. Will you play more golf? Will you work part-time or on a self-employed basis? Are you planning to retire at the same time as your partner? If so, have you started to discuss your retirement plans together? How much do you need? Well, this rather depends on what sort of a lifestyle you envisage having during retirement. Generally, most people don't spend as much once they get into their 80s versus the early years of retirement. What are your goals? You could set some specific financial objectives for retirement. Your current level of expenditure and essential and discretionary expenditure could be a useful starting point. Do you expect to spend more or less at retirement? We're also going to look at what you need to know about pensions, including the different types. So state pension, defined contribution, and defined benefit, how they work, including the options for using the funds in your pension pots. And then we'll look at tax relief on pensions in detail to fully understand the tax benefits that pensions bring. My friend Shanaka is going to begin by looking at the annual and lifetime allowances that you need to be aware of. Then moving beyond pensions, we'll explore the alternative retirement investing options. And then we'll finish by looking at some other considerations for planning for a successful retirement. So, how does one plan for retirement? Well, you can begin, as I mentioned, by setting some specific goals, such as the age to retire at, fully or partially. Many people might have a target income or a target amount in your pension and ISA pots at retirement. Always good to assess your current financial situation. Take stock of your current assets, savings, investments, pensions. Are the charges and performance competitive? Do you have flexi access drawdown within your current arrangement? Maximizing your workplace plan serves most people pretty well. Assuming it's affordable, it's the most tax efficient investment you can make with potentially free money available from the government and also from your employer. Understanding how flexi access drawdown works and how it can benefit your situation is key. That's through accessibility, flexibility, and also tax efficiency. You can also seek professional advice and talk to the experts. We very much hope that that will be us. With retirement planning, the earlier you start, the better. As with any plans, targets, or goals, a retirement plan needs to be reviewed periodically to ensure it remains on track. So, what do you need to know about your pensions? Well, charges. Do you know what you're currently paying? What has the performance been? Is it competitive? Risk levels. Are you taking too much or not enough? And what about your investment strategy? Do you have one? And if so, when was the last time it was reviewed? Circumstances can and do change. The good news is that Nutmeg can help with all of these areas. So on to the different types of pension arrangements. Defined contribution, sometimes known as a money purchase. This is where you build up a pot of money that you can use to provide yourself with an income in retirement. Defined contribution schemes have a value that goes up and down depending on how your investments perform. And whatever way you cut it, it's a tax efficient investment pot for your retirement. It's outside of your estate for inheritance tax purposes. There's no access until you're age 55, and that's planned to go up to 57 in 2028. You have a lot of flexibility in as to how and when you access the money, but the danger with these types of schemes is that the pension funds could run out, because once the pot is extinguished, that's it. In stark contrast to defined benefit plans, the amount that you receive is based on how many years you've been a member of that employer's scheme and the actual salary that you've earned while you were working there. So the pension scheme trustees provide risk management and increase the value of your benefits with inflation. So the amount paid is based on your years of service and salary, and many provide a guaranteed index-linked income for life. Can be inflexible, as once you've put the plan into payment, it's generally not possible to alter the sort of the payment schedule or to phase your retirement, which gives you less scope for retirement planning. And early death could potentially mean that you don't get the best value from this type of a scheme. So takeaway points here: a defined contribution pot belongs to you. You are responsible for ensuring that it provides a sufficient income for you in retirement. Whereas a defined benefit plan is a promise to pay a given level of benefit to you in retirement. So how do defined contribution pensions work? Well, payments into your pension, as you can see on this slide, lower your taxable income. Instead of the money you would have paid going to income tax, going into the government coffers, it goes into a tax efficient investment pot for your retirement. So as the slide shows, you put money in, your employer puts money in, and you get tax relief from the government. You can then receive investment returns on the whole pot, most of which hasn't come out of your net or gross pay. So you should end up with a pension pot valued way in excess of what you personally put in to start with. And then from the age of 55 currently, or 57 in 2028, you have a number of different options. You can take some or all of the tax-free cash. Crucially, that doesn't trigger something called the money purchase annual allowance. And you can take any amount you wish. Doesn't have to be the full 25% in one go. So that's option one on the slide there. You can use some or all of the pot to purchase an annuity. Far less common now since the government introduced flexi access drawdown, but annuities do provide a guaranteed income in retirement, potentially for the rest of your life. However, if you require more flexibility, they might not be right for you, as you're giving up access and flexibility when you buy an annuity, as all the funds go to an insurer in return for a guaranteed income for life. They're medically underwritten, and a lot of the time the income can die with you unless you specify a guarantee period. Third option, take ad hoc lump sums and or a monthly or annual income, and that enables you to leave the money invested. You don't need, you can leave the money you don't need for income invested for longer term growth. So you've got full access and full flexibility as to how you actually use the money. So you can use it as and when you need it. So in effect, you can sort of build your own annuity, or at least your own decumulation plan from your pension pot, and keep all the funds accessible to you and your family instead of buying an annuity. Fourth option, you can take the whole pot as one lump sum. And while that is possible, it's likely to mean you lose a significant portion to tax versus taking smaller amounts out every year over, say, the next 20 or 30 years. It's also possible, and important to point out, you can do any combination of the four options outlined above, subject to you having sufficient funds in your pension pot to do so. So, what's so good about pensions? Well, primarily tax relief. As you can see on this slide, it benefits higher and additional taxpayers more. Nearly everyone qualifies for relief at source. So if you put £80 in this example, the government will top that up to £100 pretty much immediately through relief at source. And higher and additional rate taxpayers can then claim this higher and additional rate tax relief by filling in a self-assessment tax return. If you can get your employer to match some of that, then as you can see here, basic rate taxpayer, again, you contribute £80 into your pension. You receive £20 tax relief through the government, from the government through relief at source. If your employer will then match this, the majority of the funds being built up in your pension pot hasn't come from your net or gross pay. This money is then available for you to use from age 55. And if you fill in an expression of wish form, it can pass to whoever you choose within the pension wrapper outside of your estate for inheritance tax purposes. So tax relief and employer contributions really accelerate your retirement savings. And it gets even better for higher rate taxpayers. For only £60, you could have £200 going into your pension pot in this example, if your employer matches your contribution. So the majority of the funds built up in your pension can be built up from your employer and the government. You then get compounded investment returns on the whole pot, most of which shouldn't have come out of your net or gross pay. So as you can see, getting £200 going into your pension pot, which is over 3 times as much. Again, additional and higher rate relief, high rate taxpayers will need to claim that additional and higher rate tax relief through self-assessment. Once you're 55 or 57, you have full access to all of the money if needed. However, you're likely to pay less income tax if you take the income part out once you've actually fully finished working. If you earn over 100,000, it can get even better still, because currently you lose £1 of your personal allowance for every £2 of income you have above the £100,000 threshold. The personal allowance in 23-24 is £12,570. So on an income between £100,000 and £125,140, you're likely to fall prey to the 60% marginal income tax rate. This can be avoided by contributing into a pension, as the pension contributions in effect lower your taxable income. So you can get your personal allowance back and you can potentially contribute this into your pension. Again, that will need to be claimed through self-assessment. Flexi Access Drawdown is an alternative to buying an annuity. It was launched in 2015, and it gives you the option to take varying amounts of income or tax-free cash from your pension pot, whilst leaving the remaining funds invested. This is particularly useful if you're planning to semi-retire, or you're likely to have months or years of varying income streams leading up to or during retirement. Currently, the maximum amount of tax-free cash is limited to £268,275. So the remaining funds will be taxed as earned income. If you die before the age of 75, you can pass this money on to your nominated beneficiaries outside of your estate for inheritance tax purposes. Your beneficiaries will be able to take the money out of the pension completely free of any tax. Difference is if you die after the age of 75, this money can still pass on to your beneficiaries, outside of your estate, but it will be taxed at their marginal rate in the year that they decide to take it. So you will need to fill in an expression of wish form to ensure that the pension goes to the individuals you nominate, and there's no limit on how many beneficiaries you can name. Flexi Access drawdown isn't necessarily an automatic feature on all plans. Some older pension plans may not have that facility in their current guise. If you have something called lifestyling in your current pension arrangement, that can reduce your growth prospects. If you don't know how much risk you're taking, how much you're paying, or if you even have Flexi Access drawdown, then it's definitely time to review your options. Older style plans can be more expensive and not as actively managed. Pension and tax rules can and do change, so it's always worth enlisting the help of a professional before you enter into Flexi Access drawdown. This slide shows some of the magic of compounding. Lower fees or higher compounded returns compound the same. So it doesn't matter if the higher annualized figure comes from higher returns or lower fees. Ideally, it would be both, but we cannot accurately predict what future investment returns will be. It's usually possible to find out exactly what fees you're currently paying. The reinvestment of dividends is where the magic happens here. You're getting growth on your growth or a bigger slice of a bigger pie as you go through time. And this graph shows just how important it is to have a good investment strategy, as just a 3% difference in returns essentially cuts in half the amount that you need to invest each month to get to 1 million over 40 years. Please note the figures on this slide are approximate and they assume monthly contributions and yearly returns. So that's it from me today. I'll be taking questions at the end, but now I'd like to hand you over to my good friend Shanaka. Thanks very much for listening and thanks for joining me today.
Thanks, James. And thank you, everybody, again for joining us today. So following from what James has just said, pensions, well, we know they're a good thing as the government has capped what we can squirrel away. Therefore, though, there are various limits that we do need to be aware of. The lifetime allowance was the maximum amount you could accumulate in your pension scheme over your lifetime without incurring any additional tax charges. It was set at 1.073 million. If your pension savings exceeded this, you may have faced additional taxes on the excess amount. However, from the 6th of April this year onwards, the LTA, as it's known, the LTA charge, no longer applies in terms of calculating tax due on any excess pension savings. The previous LTA limit will continue to apply for the purpose of capping the 25% tax-free cash entitlement James mentioned earlier. This means that for most people, the maximum tax-free lump sum entitlement will remain at £268,275. Again, though, it's important to acknowledge that the Labour Party have stated that they will reinstate this LTA charge rule if they come into power. Therefore, there may be only a limited window of time for individuals to benefit from these new rules. The annual allowance, this is the maximum amount that you can contribute to your pension in a tax year and still receive the tax relief that James mentioned. This is currently the lower of 60,000 or your relevant earnings, PAYE self-employed income. Importantly, though, this does not include any dividend or rental income that you may receive. However, it can reduce for high earners, though, through what is known as the tapered annual allowance, which I'll come to in a moment. Carry forward is another term you may need to be aware of, and carry forward is a rule that allows you to utilise unused annual allowance from the previous 3 tax years to make a larger contribution in the current tax year. This can be beneficial for individuals who have relevant income in excess of 60,000 a year and want to make a large pension contribution. So I mentioned the tapered annual allowance. This is a rule that reduces the annual allowance for high earners. The annual allowance is reduced for individuals who have adjusted income over 260,000 a year, and it's applied by reducing an individual's allowance by £1 for every £2 over that 260,000. The limit to which the annual allowance could be reduced, though, is 10,000. James alluded to the money purchase annual allowance. Now, what this is, the money purchase annual allowance is a lower annual allowance, that applies to individuals who've already accessed their defined contribution pension flexibly, i.e., they've drawn down anything in excess of their tax-free cash. Once you trigger the MPAA, your annual allowance is reduced to £10,000 per annum going forward. As you can see, these terms are critical to understand the limits and regulations surrounding pension contributions, as well as the potential tax implications of exceeding them. Okay, so we've talked quite a lot about pensions today, but what are some of the alternative investment vehicles that we have at our disposal to plan for our retirement? The first we have is what's known as the Stocks and Shares ISA. This provides an individual with an allowance of £20,000 per year to shelter away their funds from tax. This can be put into either a cash ISA, think tax-free bank account, an investment solution, or a combination of the two. Whilst we do not receive tax relief on our contributions into an ISA, meaning the government won't boost our contribution, the funds are allowed to grow tax-free. However, we can choose when we want to access the money, and the proceeds will be free of any tax liability. Another vehicle is the Lifetime ISA, also known as the LISA. This is an initiative that was set up to assist individuals that are saving for their first property purchase or putting money away for retirement. Between the ages of 18 to 39, any UK resident could open an ISA, and contribute up to £4,000. The government would then pay a bonus of 25% on top of this, so a maximum of £1,000. Any individual could continue contributing until their any individual can continue contributing into their LISA until the day before their 50th birthday. Again, any growth would be tax-free, as would any withdrawals, as long as the funds are used towards purchasing the first home, up to £450,000, or the funds are withdrawn after age 60. In any other circumstance, money can be withdrawn. However, there is a 25% penalty applied to that withdrawal. In addition, any money paid into this wrapper, a LISA wrapper, counts towards one's overall £20,000 ISA allowance. Now, another vehicle to be mindful of is a general investment account. These offer the individual the opportunity to invest further funds into investment solutions and can be especially useful for those who have already taken full advantage of the other available tax wrappers that we've already mentioned. Whilst there may be tax applied to any growth and subsequent withdrawals, utilised in the right way, they offer not only the ability to further grow our wealth, but also utilise other allowances such as our dividend and capital gains tax allowance. Another strategy often employed is to filter money from the general investment account into our ISAs to utilise any unused ISA allowance. So, as we discussed, there are different vehicles available for an individual to accumulate wealth for later life. Whilst no one size fits all, simply in terms of tax efficiency, utilising our pension allowance, followed by our ISAs, and then considering a general investment account, is one way to accumulate tax wealth. Conversely, when it comes to withdrawing our investments or decumulating, the reverse approach may be beneficial, as it allows us to take advantage of all of our allowances, such as personal income tax allowance, dividend allowance, and our capital gains allowance. It's important to note that the tax wrapper, though, only alters the tax treatment of the assets in the pot. Therefore, the underlying asset allocation will determine what growth will be also. I will come to how Nutmeg has been assisting our customers to do this in a moment. Please remember, though, that everyone's needs and circumstances vary, and this is where a qualified financial planner can help to ensure you're making or optimizing your resources in the most efficient manner. So whilst it's important to ensure that we're utilizing the available wrappers at our disposal, it's also essential to consider the following when we're growing our wealth. The first one is inflation. Inflation, put simply, is an increase in prices over a given period of time. Therefore, the question is your money invested so that it can maintain its purchasing power for when you require it in the future? Many of us will be saving part of the money that we've worked hard to earn. If the return, though, that we're achieving isn't keeping pace with inflation, ultimately the money will purchase less when we come to need it in the future. Therefore, it's extremely important that the funds not only have the potential to keep pace with the rise of inflation over time, but exceed it. Charges are another thing to be mindful of. Many people do not know what they're paying, and more worrying, the impact that excessive charges can have on the pot that we enjoy in retirement. When it comes to investing, the reality is many things are ultimately outside of our control. However, two things that we can control is ensuring that we're not paying unnecessary charges or tax. This ensures that more money remains in our pots and, as James mentioned, compound over time. Risk level is another thing to consider. This relates to the amount of volatility we are comfortable to accept when it comes to growing our money. There are many rules of thumb you may have heard of, including stocks and shares may suit people looking to put their money away for the medium to long term. The younger one is the greater the argument that they should be exposed to stocks and shares investments. The reality is, though, however, this is a bespoke decision driven primarily by your goals, attitude to investment risk, capacity to accept risk, as well as the necessity to take risk. Again, this is where many people can benefit from either financial guidance or professional financial planning advice. Investment strategy is another thing to be mindful of. Many of you on the webinar today will have enrolled within your employer's workplace pension scheme. Employer schemes tend to invest you typically in what's known as a default fund. Whether you're just starting your career or a day from retirement, you may find you're in the same one-size-fits-all fund. Therefore, this could either be exposed to too much volatility or conversely, limiting your long-term growth potential. Think one foot on the brakes. Therefore, it's vital to ensure that your investment strategy within your pots reflects your needs and requirements. As mentioned, it could be easy to dismiss charges that we're paying to have our money managed for us. However, that can be one of the biggest hindrances on the level of risk we're able to accumulate over for our retirement years. This graph highlights the difference an extra 1.5% per annum in charges can have on the fund that we enjoy in retirement, demonstrated here by the reduction to the return the customer receives over time. Over 40 years, this reduction in performance has reduced the total pot by a staggering $374,000. This is a lot of money to leave on the table that could no doubt be better spent by yourself on holidays, hobbies, and building memories with loved ones. As I previously mentioned, there are two levers we can control when it comes to building our wealth: minimizing charges and mitigating unnecessary tax. When it comes to investing, it's really a question of how much involvement you want when coming to manage both your retirement investments now and in retirement. At Nutmeg, we offer discretionary fund management across 4 different investment styles. Our approach is to create globally diversified portfolios created and managed by our expert fund managers. Fixed allocation portfolio is one of these strategies. This portfolio tends to favor our customers who want to invest in a globally diversified portfolio constructed by our expert investment managers in line with their attitude to risk, having the peace of mind it's periodically reviewed. Then also have the fully managed portfolios. Similar to the fixed allocation portfolios, these are globally diversified portfolios that can be aligned to an individual's attitude to risk. However, there is now ongoing strategic management from our expert investment managers looking to continuously react to both macro and microeconomic data. The socially responsible portfolios, these are here to provide an option for our customers where this is one of their main drivers. Whilst all of our portfolios aim to be as socially responsible as possible, and they're all independently accredited, this portfolio takes it to the next level in terms of what's included, just as importantly, what is excluded. Therefore, this offers a solution to our customers where social responsibility is their primary investment preference when growing their wealth. And lastly, we also have our Smart Alpha portfolios. This is our newest investment strategy and has been running for 3 years. When we became part of the JP Morgan family, it allowed us to tap into the 150 plus years of investment experience that they have, combining Nutmeg's key fund principles with the research and analysis of 1,300 plus investment professionals and 600 plus investment strategies within JPM. For 10 years now, Nutmeg have been providing their clients with the belief that investing should be clear, straightforward, and experienced as possible, keeping charges low with transparency around performance and knowing where you're invested. Now part of the JP Morgan family, we have grown to become the largest digital wealth manager in the UK. The timeline here shows how we've grown over time and how we have now offered multiple investment vehicles to help our customers grow their wealth. Please remember, regardless of what vehicle or vehicles used, it is the underlying strategy, the investment strategy, that sits inside these wrappers that will do a large proportion of the heavy lifting for you over time. However, some people will want more than guidance to make their own decisions when it comes to saving and investing. They may want personalized professional recommendations, and that's where financial advice comes in. Our regulated financial planners can assess all of your individual circumstances and help you plan for what-if scenarios before then helping you to create a financial plan completely tailored to you, then also help you to put it into place. As restricted financial planners, we specialize in helping our clients optimize their investments and pensions, and where required and suitable, recommend Nutmeg products and services to meet their needs. Well, we hope you found today's webinar useful. If you would like to have a one-to-one conversation about anything we've discussed today, either click here or use the QR code. But I'll now hand back over to Gary to see if we've had any questions.
Thank you, Shanaka. Thank you, James. I've really enjoyed the presentation. Thank you very much. I've actually learned quite a lot in a very short time. Time is of the essence. We have had lots of questions come in, so I'm going to just pick a few out that we can chuck to the guys, and then maybe, obviously, if you want to book a free call afterwards, you can potentially follow up any questions that way. One question we've had a few people asking around aspects around tax treatment when it comes to taking money out of your pension. So I think that's one we'll tackle first. So the first question is, do you have to take the 25% tax-free lump sum as one payment, or can you phase that payment over time? James, do you want to take that one on?
Yeah, sure. It can be phased over time. So yeah, you can take it over multiple years, multiple tax years, and that's available from 55 or from 2028 from age 57.
Okay, and just a follow-up question on that one. What happens to the remaining 75% of the pot? I guess we're talking here about crystallization here and tax treatment.
Yeah, so that would remain invested for growth, assuming you left it invested for growth. But the idea being, lots of people treat themselves to a nice family holiday or possibly a new car or something like that. So you're free to do that and leave both the tax-free cash and also the unused income in the pension pot sort of unused. And that would continue to grow, and you can potentially, continue to get returns until you actually fully retire.
And it just another one kind of on the same kind of topic. Can you buy an annuity and then also use a proportion of your pension to stay in drawdown? So essentially, can you mix and match?
Yes, absolutely. You can. Yeah.
Okay, another question on tax relief. Sorry, I'm rushing through these quite quickly, but we want to get through a few. If you are a higher earner and you are contributing to your company pension scheme, is the tax relief applied at the point of contribution, or do you have to do that yourself via self-assessment?
Yeah, I can take that one. I guess the answer is, for most people, yes, it's taken at source if it's via a company pension scheme. Gary, and that's through something that's known as salary sacrifice, which essentially it comes off your income before you're taxed, and then that's how obviously you're getting your relief that way. There are some instances where that isn't the case. It's taken from your after-tax income, and where that's the same, you would need to, if you are a high rate taxpayer, complete a self-assessment at the end of the tax year to receive that additional 20% tax relief.
Marvelous. Another question here around carry forward. If you have, say, £10,000 of unused allowance for the past 3 years, does that mean that in the current tax year, for example, that we could exceed the annual allowance by £30,000? So I think what we're saying here is can you bring your carry forward all to 1 year?
Yes, potentially. You need to have used the most recent year's allowance fully, and that gets used up first, and then it works on a sort of rolling 3 years. So you use the oldest years first. So yeah, potentially.
Okay, and we've had some questions around the Nutmeg portfolios. One in particular here is, what is the major differences between Smart Alpha and fully managed portfolios? And can you actually have a combination of different investment styles?
Yeah, I can take that one. Yeah, absolutely. So I guess the difference, first of all, between the two is they're both what we would say actively managed funds, i.e. they have constant insight from our expert fund managers. The key difference is, though, that the Smart Alpha portfolio also has additional insight from JPM, as I mentioned, and their 1,300 plus financial analysts and 600 plus investment strategies that they employ. It can leverage that as well. So it typically tends to seek people who want that extra element of active management and are prepared to pay slightly more for that.
What happens to a defined contribution scheme when you die, and also does it differ if you have multiple pension pots? Good question.
It certainly could do if you don't have flexi access drawdown on all of them. Assuming you filled in an expression of wish and you have flexi access drawdown, they can all pass to your beneficiaries. Having multiple pots, doesn't per se change it, but you could potentially be having higher charges, and a lot of people find it more convenient to have them all in one place. But the act of having multiple pots doesn't sort of directly affect what the treatment of them will be on death.
Okay, and one final quick question. Do you have any thoughts on consolidating different pension schemes from different jobs or employers? Is this a good thing to do, and could it save me on costs?
I guess, yes, potentially. Many people will look to do that just for many reasons. There may be savings in charges, amalgamation, ease of administration, directing the investment strategy. So lots of potential pluses to it. I guess the caveat you always have to do, make sure people are aware of, is that you have to make sure you understand the schemes first. There may be valuable benefits in the background, especially with older schemes, that may be quite valuable that you'd be giving up. So yes, in many cases, it could be a good thing to do, but you just need to be fully informed and mindful of what you're doing.
Thank you, gentlemen. I shall bring this session to a close. Thank you for your wonderful insights. Thank you to everyone who tuned in and all the great questions that we've gone through.